Blockchain Real Estate Podcast, sponsored by the Blockchain Real Estate Summit. If you're interested in the intersection of real estate, blockchain technology, AI, and more, you've come to the right place. Don't miss your opportunity to attend the Blockchain Real Estate Summit 2024, happening this September 24th through 26th, online for our worldwide audience. Get your tickets at blockchainrealestatesummit.com/registration. Enjoy the show.
Thank you for coming to the Blockchain Real Estate Summit podcast. We have a great one here. I'm kind of a Dr. Robert Murphy, or as he likes to be called, Bob Murphy, fanboy. I've known about him for years now, originally hearing him on the Tom Woods show. And one of my favorites with Bob Murphy used to be the Contra Krugman show. So that was always excellent. And I learned a lot from Bob, especially clicking through the links to see what they're actually saying instead of like what they're making up saying. But before we start, I'd like to remind everybody that this is not financial advice. This is not legal advice. This is not accounting advice. Anything that you do, you should go and have professionals look into it. And just to remind you that the Blockchain Real Estate Summit is again happening this year, September 24th through the 26th. It's 3 days. It's 3 time zones. We've got Europe covered. We've got Asia and the Asia time zone covered. And we've also got the Americas covered. We've got more than 40 we've got speakers from about 40 different countries. As usual, what we like to say is this is changing the world. It's going to be a worldwide phenomenon with real world assets and real estate assets. But speaking of real world assets, I'm not sure if life insurance and insurance in general is real world or just a financial asset. So with that, want to introduce Dr. Robert P. Murphy. He is you're still with Texas Tech, right, Bob?
No, I used to be, but no, I'm
okay.
not.
All right. So he is a real professor. He is an economist. He's well known for his work with the Mises Institute. He also did some work with the Nelson Nash Institute. So if you're interested in infinite banking, Bob has a really great podcast on that. I'm not sure he's doing it again, but it really explains infinite banking and how to use whole life policies to do banking. Bob has done so many things. It's really hard to nail down, but he's got probably like 5,000 different podcasts. I'm just, exaggerating on that, but every time I hear him, I love what he says. I just have some disagreements when he starts talking smack about real estate. But we're here in Bob's official capacity as the chief economist for Infineo. And the really kick-ass thing about Infineo is that they're tokenizing life insurance policies, and they've got a bunch of other different programs. But what I'm most interested in is talking to Bob a little bit about why he got involved with Infineo and what Infineo is up to now. So with that, Bob, why don't you just give us a little bit more information? And if I slandered you in any way or had the wrong information, you can correct it now.
Okay, well, thanks, Michael, for this inviting me on the show. Glad to be here. And thanks for the kind words. So yeah, the only inaccuracy is I do host a lot of podcasts, but you were rounding up to the nearest 5,000 with that estimate. So yeah, the backstory, to give relevance to your listeners to understand, why am I here in this capacity as the chief economist at Infineo, and how does this tie into what you're doing in terms of Blockchain Real Estate Summit? So I started out in academia. As you said, I was first at Hillsdale College. I ended up at Texas Tech. I'm a member of what's called the Austrian School of Economics. And my area of research focus was, I guess you'd call it money and banking.
Okay.
And then I got out of, pure academia, and I ended up in the financial sector, and for various reasons. And I eventually, when I lived in Nashville for a period, I encountered this businessman, Carlos Lara, and he introduced me to infinite banking. Specifically, he handed me Nelson Nash's book, Becoming Your Own Banker, Infinite Banking Concept. And I confess,
right there, it is a great book, and it's supplemental stuff that you can find on the internet. It is a fantastic saving strategy. With that, I'm sorry to interrupt you.
No, no problem. No problem.
Okay.
So I confess, and Nelson, Nelson's no longer with us, the guy who wrote this book. But he, he's heard me give this answer. So this isn't like trashing his legacy. He knows I said he thinks this is amusing. That I confess, had I encountered Nelson's book in a vacuum, if he had mailed it to me or just some random person, I would have glanced through it and just thought, no, this guy doesn't know what he's talking about. There's like 5 things wrong with this book. Like, he seems like a great guy, like salt of the earth. You'd want to have a beer with him or something. Great guy. You'd let him watch your kids. But no, there's at least 5 things wrong with this book. But what was happening is I didn't understand how whole life insurance worked. Even though I have a PhD in economics from a top 15 school, I just thought of it as like term insurance that, just like how car insurance or fire insurance on your house works. That's life insurance. And no, what Nelson was talking about was whole life insurance, which is a form of permanent life insurance that has a cash value that grows over time. And so that's something that, that's unique to life insurance, that it's not like, you can have car insurance and every payment you get a higher and higher surrender value that you turn in your, what I mean? There's just, that thing doesn't exist even in P&C insurance. And I've talked to, in my role here at Infineo, which I'm going to get to in a moment. I've talked to plenty of experts in other areas, and I realized just how unique life insurance is with this cash value aspect. But anyway, so as I started doing more research and understanding that, and I only kept with it because I respected Carlos so much that, he's a successful businessman. He was also a fan of the Austrian school. The reason we met is he was doing a PowerPoint going around to bankers, showing them how they had contributed to the housing boom and bust because of fracture reserve. And anyway, like, it was just, he's an interesting guy, right? And he was using one of my study guides to help make sure that his economics was right. So anyway, that's why I stuck with it. And then after a while, I was like, oh, okay, that one little thing that I thought was an error in Nelson's book, now I get what he meant. Okay, but still, there's 4 things wrong. And then you can see where this is going. Just the more I learned about how whole life works and the more I understood what Nelson was trying to do in that book, my objections kept melting away until it got to the point after about 6 months where I said, well, this is obvious. How come everyone's not doing this? Right. Yeah. And so it went from me thinking this is totally wrong to this is so obvious. How come no one's doing it? And so then it got to, once I thought it made sense to use whole life policies as like a cash management tool. And for the listener, that's what it was. Like, you build up the cash value and there's inbuilt contractual guarantees that the carrier will make loans against the cash surrender value, with that serving as the collateral. And so it's just a nice way that you can manage cash flows, and there's tax advantages and stuff like that in Canada and the US if you set it up right. So that's what it was. But there was like this small group of life insurance professionals, who specialized in this product, and they thought Nelson was a genius. But a lot of those people, they knew that it worked, but they didn't know exactly why it worked. And so they would come up with like stories and metaphors and analogies to motivate it to their prospects. Like, this is why, you can do this and bank with your life insurance policy and did it. And a lot of times it wasn't quite right. And it was like, no, you're going to mislead people. And also too, there was compliance issues where, in general, the life insurance sector doesn't want you calling something a bank, that kind of thing.
Right.
So with Carlos and Nelson Nash and David Stearns, who was Nelson Nash's son-in-law, we all formed the Nelson Nash Institute, and we developed a training program for life insurance professionals to understand, how this product works, and then also to kind of give strategies like, this is how you can explain it to your clients or prospects, in a compliant way that
to be legally
accurate.
compliant. Yeah.
So don't worry, the lights at the end of the tunnel here, Michael.
No.
Give your show back
because because we're going to talk about it a little more. So keep going.
Yeah. So Cole Snell happened to be a graduate of that training program. So he, for a period in his life, he had a successful exit from the food industry. He was Canadian. Mm-hmm. And so when he was talking to his financial advisor, that person said, Cole had a big exit, and so he had a pile of money to park somewhere, and this person told him, put it into whole life insurance. And Cole, did a double take, and what? That's the craziest thing. Why would I do that? And he said, go do the work. And so Cole went into the research, or whatever, found, Nelson's stuff, my stuff, and whatever, and then became convinced. And then he became so passionate about it, once he was doing it himself. I think at one period he had something like 14 policies, that it was real easy for him to get other people to want to do it, because he would just, a client would come into his office, Cole would just lay out his own portfolio on the desk and just show him, this is what I do. I like borrow, I pump as much into the premiums as I can to fund these things. And then if I need cash, like if I want to go buy some Bitcoin or whatever, I take out a policy loan, look at this, da, 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 da. And then other people, especially those with like business owners with large cash flows, because that's, the really ideal person for this strategy. It's like, yeah, I want that. And so Kolb was very successful, as an agent. And so he went through our training program. So that's how he and I first knew of each other. And then when he left life insurance production, he realized, one of his passions was also Bitcoin blockchain technology more, fundamentally. And he said, infinite banking, as Nelson's disciples called it, is great. But right now it's really limited just to the US and Canada, because, to get these policies designed the right way, that, the carriers have to have a product, with these certain characteristics. He said, but if we could take these policies and put them on the blockchain and then issue digital tokens that are, representative claims on those underlying policies, that opens up the whole world to experience at least a lot of the benefits of, cash management with whole life. And so so once he wanted to do that, he said, well, what economist do I need to be working with me?
Right.
Clearly the guy who's written several books on this life insurance stuff. And also I had written a book with a co-author on how Bitcoin works, like the economics of it. And so, he recruited me eventually. I said, yep, this is the team that's going to do it. I could, tell the other people were really qualified and serious. And so that's what we've been doing. So among other things right now, we've recently launched our policy ledger, where people can put their own life insurance on the blockchain. And we've got this about like $120 million on chain right now.
So I'm going to now interrupt you because
yes, I'm done. Go ahead.
No, we're going to break up some of that
Yep.
stuff and focus on it so that people understand it a little better. So, so I do want to talk to you. You guys put about $125 million of policies on the blockchain. We're going to get back to that. I want to first talk about the infinite banking system and how it fits in with Infineo. But let's make it simple, because Dave Ramsey and all these other financial genius gurus tell us that you should never buy whole life. You should only buy term, because it's like between renting and buying. So why would you want to spend all the money on that? But the light went on for me when somebody actually explained it to me. It's like, well, and it really went on for me because I bought when I first got married years ago, term life, and the term life just kind of expired.
Mhm.
But I also had a universal policy, which was not the greatest way to do it, but at least it had, an income thing. It had cash value and it increased in value with the stock market. But what I finally figured out with the whole life policies, and I also made a bunch of mistakes along the way, because people told me, oh, you're saving for college for your kids, so you should buy the state savings bonds, and they're tax-free, which, was not a great idea. And you should also, especially if you're investing in Illinois state savings bonds, but and then 529 plan, also a bad idea, because Illinois treasurer, the first thing the new treasurer always does is they give it the management to their buddies. They lost half of, my college savings. Luckily, my kids weren't. Luckily, my kids got scholarships, and they weren't going into college at the time that, it lost 50% of the value. If I would have known, I would have started a whole life policy on each kid and put the money in the whole life policy and kept adding to it, just like I was adding to the 529. It accumulates in value tax-free. But at the end of that, when they're ready to go to college, maybe they don't want to go to college. Maybe they want to start a business. Maybe they want to do something else. With the 529 plans, you could only pay into a college situation. And I couldn't even use it for the kids going to a private Catholic high school. So from me, and it's the same thing with a retirement policy, an IRA. The Obama administration at one time wanted to start taxing IRAs because, people were saving too much money and stuff. So one of the great things about whole life policies is that this money accumulates tax-free in there. It's a tax advantage vehicle. And so I really started like taking a look at it because every time I had to fill out a financial form for a bank, it always asked how much life insurance I had and what the cash value of it was. Like, well, they're like actually taking this as an asset, so it's a
Mhm.
real thing. So that's, the lights kind of came on. And so when I found out about infinite banking, like I said, I found out about it a little too, it's not never too late, but it was too late to avoid some of the mistakes. So every time I, see young people, they're starting families, they're just getting married, they're doing stuff, I'm like, take a look at the 529, but I'm going to recommend you do this instead because your kids then have an asset that they can do with what they want instead of something that, what the government is going to tell them to do. And the government can always change those laws because they make the laws. So that's
Yeah.
my feel.
Yeah. Great stuff there, Michael. I mentioned, at Infineo.ai, if your listeners are curious, I have like a white paper, I guess you could say, or a report that I wrote up, to dovetail. Cole and some co-authors had written a book called Child Millionaire, where we're
Hmm.
going over like a strategy, like a method of passing on wealth to future generations. And in my report, I kind of just went through some specific numbers. Like, yeah, you have a newborn, you can take out policies, and then as you say, as they get older, they have options. And then I chose the numbers such that they can, so long as they agree to use it to fund it for their kids, then there's still going to be plenty left for them, to use for themselves. And so it's this thing that like with each generation, it just keeps growing so that the family has this, like, this growing stockpile of assets that they can borrow against, like a little pool of wealth for the family. So yeah, another thing you said that I was similar to my experience when I mentioned at first, I didn't believe in this stuff. I just thought it didn't make sense. Then I started to understand more about how whole life worked. And one of the big revelations for me when I was doing my due diligence, I guess you could call it, is I went, what in general, when I encounter some controversial claim, what I do is I try to find the best people on both sides of the issue. And so
Hmm.
I read, Nelson, of course, and the other people, I went to the conferences where there were, CPAs and stuff getting up there and talking about the tax treatment, and my clients have survived audits. This works. This is real. This isn't a scam. That kind of stuff. But also, I was going because you go and Google this stuff, and yeah, like you say, Dave Ramsey, Susie Orman, people like that will
Right.
say this is terrible. This is crazy. And the big mantra is buy term, invest the difference. So I got hip deep in that stuff, and the just that analysis, especially like in the hands of a Dave Ramsey, where he just glibly he thinks in 2 minutes blows it up, like saying you should never own whole life, period. It was just full of non sequiturs. So that doesn't mean whole life was good, but it did kind of concern me and make me think something's not right here when all these people saying how stupid it is, their arguments made no sense. So just one example of what I mean, like, because you alluded to it, is they'll say, oh, look at how much more expensive the whole life policy is for a given death benefit than like a 30-year term. Well, right, but that's because the 30-year term expires. And for most
Right.
people,
Right.
they're going to pay into that thing for 30 years. It's going to expire. They're not going to see a dime of it back. And that's fine.
Right.
That's how the product works, but that's why it's cheap. So I would say to people, do an experiment, take the same death benefit and look at what the premium is for a level 5-year policy, a 10-year term policy, a 20 and a 30. And you'll see the level premium goes way up when you start from a 5 and go to a 30. And I say to crowds, why is that? And they're like, well, obviously, because you're more likely to die over a 30-year horizon. I say, okay, so if you're like a 30-year-old and you take out a whole life policy, that's like a 91-year term policy, right? Because that thing is in force at least to age 121, at which point, you get the death benefit, even if you happen to still be alive. And so I was saying, if you can understand why the premium has to be higher the longer the term is, well, for a whole life policy, whereas the name suggests it is there for your whole life, it doesn't expire on you. That's why they got to charge more. It's not because they're ripping you off. That's just the underlying actuarial mechanics of the mortality tables. So anyway, just things like that where I just started to realize just how crazy, Dave Ramsey's glib dismissal was. And then that made me realize most people in the financial sector don't really understand how whole life policies work.
Well, and the whole invest the difference thing doesn't work. Well, it does if you actually do it. But I started out with the term, and I started out with, okay, I opened up a mutual fund, and I was putting like $100 a month in, dollar cost averaging in and stuff. But life comes up, and it's like,
Mhm.
oh, what's the easiest thing to give up? Okay, the easiest thing to give up is I'm putting money in this thing. And then the other issue with the invest the difference is the volatility in the stock market. Okay. If you get a 50% decline, which, there's been a ton of drawdowns, and we won't even go into like, the actually what you're making out of the stock market with all the drawdowns and the volatility. You end up with, not as much. And then most people, when they're in the stock market and it does that type of drawdown, they pull all their money out because it's like, oh, I'm going to lose everything. And so they don't get even back. But it took me forever to get back to that. And then that money is, I look at the stock market as, just, and I also look at real estate, but I will talk about why real estate I think is better. That it's just them inflating the money supply. And when the money supply goes up, the stock market goes up to a similar thing, which what I do like about, you're not getting a super fantastic return with whole life, but you're still getting a better return than a savings account, and it's tax advantaged. And I trust mutual life insurance companies sometimes a lot more than I do banks. So they're not even as leveraged as banks, and they're better run than banks most of the time.
Yeah, I agree with everything you just said there. Just to piggyback on some of your points, right? That's to me, like you kind of stress some of the, I guess you might call them psychological factors. But even if you had a robot doing everything mechanically with perfect discipline, still, you just put your finger on one of the huge problems with the quote buy term and invest the difference strategy, especially like I say in the hands of a Dave Ramsey. He'll do stuff like say, oh, if you just put this in a mutual fund, that would earn you, over the last X number of years, 12% or so. And it's clear it must have had exposure to the stock market. You know what I mean? That wasn't like a treasury fund for the time frame he has in mind and what he's saying the annual returns were. And so, you got to look at the difference of the two assets. That a whole life policy, it's not just the return's decent, and for people, frame of reference, it's like long term, you can get into annual rates of return on the cash value relative to the premium payments of high fours, low fives, depending on the company and whatnot. So, and then that's it's more if you take into account the tax implications, the tax effective rate of return.
You're putting that tax, that income tax, you're putting those earnings on top of your regular earnings, so they're being taxed at the highest rate. Even if you put it into dividend stocks, it's the same thing.
Right.
Versus,
but so, just saying that, so that's a decent rate of return, like you say, better than a savings account.
Right.
But then on top of that, the fundamental thing, also like a savings account where, once you get your dividend and you get your rate of return, in your whole life policy and the cash value appreciates, it can't go down. That's the cash surrender value. It's contractually guaranteed. Whereas, as you say, the stock market can go down or not. And so it's completely unfair. It's apples to oranges to look at the rate of return on a mutual fund that's very, highly exposed to the stock market, even if it's broad, S&P 500 or something, versus a thing that's supposed to be, they're serving quote as a bank, in Nelson Nash's phrase, right? That's a warehouse for your capital is another way he described it. And so, when responding to Dave Ramsey, I would say something like, I could just as well quote prove that you're a fool for ever owning bonds, because look at over the last X number of years, the stock market outperforms the bonds. So why would anyone ever own bonds? You can make more, and then if you said it like that, you say, well, because bonds are safer than stocks. Well, duh. And so likewise, a whole life is far less volatile. It's safer than the stock market. And so it's not enough just to look at, the higher rate of return and expectation ex ante on the stock market.
Right. And here's what I get into. You're always talking smack about real estate, but major home, yes. At least,
well, probably a long time ago I was.
No, when you say I hear it, so it probably sticks out more. So when you're talking about how great life insurance is, and I'm like, wait a second, Bob, I've done I've been partnered with life insurance companies that we owned shopping centers together, and I've gotten loans on from shopping centers, very, very conservative loans. So the loans that we took from State Farm and stuff like that, they loan to us 50% loan to value. So the one thing about life insurance companies is sometimes they haven't even been able to get into when it's a hot real estate market, they can't get into it because, some of the lenders out there are, lending on crazy stuff and lending on crazy terms versus especially the mutual companies, are very conservative on what they're lending. But they, in most, I don't think any of them really own real estate anymore. They used to own it. So like the joint venture that we had with Phoenix Mutual Life Insurance Company, it was their last direct owned property. So they wanted to get out of that because they now hire and do a lot of funds or get into just direct lending and things like that. But
Well, I don't
no,
know, just on that point, Michael, I don't know if you've seen, but there's some kind of neat, like old timey videos from like the 60s, like a life insurance promotional ad or something, with the announcers with the booming voice, and it's black and white, and the Prudential, it might not have been Prudential,
right.
life insurance company is funding the construction of skyscrapers and local shopping malls and and it's just showing all these guys busy building stuff and how that's all provided. So
Well, the
yes,
joint
and
venture that
especially
we
back
had,
then, yeah, as it was
joint
as
venture we had originally started in 1968. So
yeah. So
that's
anyway, yeah, it's that stuff, especially historically when it was harder to get sources of funding and whatnot. That yeah, like, everybody would save in the form of pumping money into their life insurance policies, and then they have all this capital sitting there. And yes, one of the things they would invest in would be real estate projects that were conservative.
yeah, but I mean, especially, and then we will go on to Infineo, I promise. But especially, when I learned more about what you guys were doing, it's like this is a much better way to even do finance, in the world. Because it's not only providing this like death benefit protection and all the rest of it, but it's a much more conservative way. It's not like the insane leverage that some of these banks have. And it's just I hope it's not nostalgia on my part, but it's just to me it's a better way to run a financial system. So
Oh, right. I mean, that underlies the whole point of, what we were trying to do with the Nelson Nash Institute. And then now, as I have gone over to Infineo, what I'm trying to do with those guys is, yeah, give them a more stable, sounder framework for the financial sector. And yeah, so for, a carrier, when you take out a policy loan from them, they need to get that money from somewhere. It's not just on the life carrier's books.
right,
The act of them granting you the loan magically
right,
makes their assets and liabilities, whereas that is what happens with a commercial bank. So it's kind of a weird thing if people don't know how commercial banking works. But yeah, when they give you a loan, credit your checking account by $10,000, from their point of view, like their assets and liabilities just both went up by $10,000. Whereas the carrier, if they're going to give you a $10,000 policy loan, they need to get that money like from incoming premium payments from other
yeah,
people. And then instead of putting the money to work by buying bonds or whatever, they instead give a loan to the policyholder. And so
right.
now the carrier, that cash, they had cash, it went out the door, and now they have on their asset side, that loan from you, that IOU. So yes, they can't create money out of thin air the way the commercial banks can. And so in that sense, it's more, legitimate or honest or stable, whatever term you want to use.
Yeah. Well, like I said, I think it's, and there's a place for banks, and I think there is, but more and more I'm liking them a lot less. But why don't we talk, because this is why we brought you on, about Infineo and some of the stuff that Infineo is doing, and explain to me a little bit better how people outside the United States, and we'll get to that, but talk a little bit about, all the products that Infineo is doing and how it interacts with the blockchain.
Okay, sure. So I think probably the thing I should start with to just interface with what we've been talking about up till now is to explain, okay, so, Michael and Bob here have been talking about the virtues of using at least a specially designed whole life insurance policy that, as a cash management tool. Okay, and it's got these attributes, and yeah, maybe the critics don't know what they're talking about. Fair enough. Well, so then what does Infinity do? Why put it on the blockchain? What does that add? Is that just, some extra rah buzzwords? No, what's going on, why it's so significant is as good as, just someone starting from scratch and buying whole life policies and building up a portfolio the way like Nelson Nash would have recommended. And then, over time, you got lots of your income flowing in, making premium payments, and then you got all this cash value accumulating. As good as that is, it takes a long time to get that system up and running. And so a few moments ago, when I said, depending on the particulars, you could have a life insurance policy that when, including, the premium you got to pay, the cash value rises at about, high 4s, low 5%. That's only if you got 20 years into the policy. In the beginning, and infamously, if you take out a brand new whole life insurance policy, you're losing money on the first year. You
Right.
got to pump in 10 grand in premiums, and the cash value is only going to be, 3,000 or something, depending on how you structure the thing, 5,000 if you're lucky. Okay. So and it takes a while just to even, again, for a standard policy that without bells and whistles and designers, it could take 7 to 8 years just to break even. Okay. And so that's a hindrance. Also, if you're just looking at life insurance as an asset class, besides that issue, there's also the problem that, you can't just call up a life insurance company and say, yeah, give me 10 million in whole life. The way you can, call up your broker and say, yeah, I want exposure to treasuries, or I want some real estate in Arizona and get, find a REIT or something. You can't do that with life insurance. They say, well, are you taking out a particular policy? Who's the insured? What's your insurable interest? Let me go run the financials to make sure, you see how much the underwriters are going to say you can do here. Right. So there's that element. You got to do if it's a big enough policy, you got to, someone shows up and takes your blood pressure and you got to pee in a cup. Right. So it's a hassle to go through all this if you were just trying to look at this as more of like an asset class rather than as life insurance that has these other benefits on the side. And so because of that, those are some logjams. Also, too, you got to make premium payments, right? So that's why, even though there's many respects in which this is a neat asset that, it's less volatile than the stock market, it has a higher rate of return than a savings account, things like that. But yet, you got to make payments on it. Whereas if you buy a piece of real estate or something, that's throwing off income to you. Okay. So, or even if you just buy gold, yeah, you got to pay storage costs and insurance maybe, but it's not, you got to keep kicking in money or else the gold bars disappear. Whereas with life insurance, you got to keep making a premium payment or it goes away. Right. So for all these reasons, so what we're doing in Infineo is, one of the products is called the Sound Token. What we're doing is, through our partners with life settlement companies who have the right licenses, they're acquiring policies, from people who want to get rid of them. We obtain them. We put them into a pool. So now we've got a pool of a bunch of whole life insurance policies. Then we issue the Sound Token, which is a fractional, it's a digital token that's on the blockchain. It's a digital claim that's, legally binding and whatnot with the regulatory framework on, it's a share, a fraction of the underlying aggregate cash surrender value of that whole pool. And so we can come in and we can only, we can curate the policies that we select for inclusion into the pool. So we can just say, no, we only want a whole life policy that's at least 9 years old. So it's already starting to get into the sweet spot of when its annual rate of return is pretty good. So we jump over those first, 9 years or whatever it is of when the policy actually doesn't do very well.
I'm going to kind of stop right there. So the Sound Token is almost like a mutual fund for buying life insurance policies, because you're creating a portfolio of life insurance policies to, reach some sort of, whether it's income, whether it's, this and that. So,
yep. Yeah. Another analogy I've heard people say, it's like a mortgage-backed security, except instead of being a pool of mortgages, it's a pool of whole life insurance policies.
Right. My next question is it a security? So is it a security token offering?
Yes. So life insurance is not deemed a security,
right?
A given life insurance policy. But if you put them into a pool and then issue fractional claims in the pool, yes, those fractional claims are securities. And so, yes, we are filing it as such and, going through all the right procedures to do that and the like.
Are you also doing like a Reg S so that non-US investors can invest in the pool, or doing a separate pool for non-US investors?
Yes. So I can't go too much more into the details just because this isn't my area of expertise here. Like we have other people, but yes,
stop with the regulations.
We are filing it appropriately such that, accredited US investors can get exposure to it. And then yes, foreigners can also.
Okay, perfect.
And yes, it is a security as far as everybody is concerned.
All right. Well, this just explained, because I couldn't figure out how non-U, like you, and I've heard you and Cole talk about it too initially on your. We should also talk about what's the name of your Infineo podcast again?
Infi,
yeah. So you guys initially talked on the first few Infi podcast. You and Cole talked about it, and I was trying to figure out how people could get exposure to life insurance without actually buying the life insurance, or as you said, I believe it's the United States and Canada and maybe the Bahamas or a few other places are the only ones that have life insurance, probably Great Britain too, that have life insurance kind of like we do. The rest of the world does not have whole life policies. Is that correct?
Yeah. So, I mean, I hesitate to make blanket statements
Oh,
because, when you do stuff like, someone's, and,
I'm
this,
not
this
trying to
place.
nail you
Yeah.
down. I'm
Right.
just
But,
saying in
but yes,
general. Yeah.
for sure, what I can say is, yeah, it's not readily available in other jurisdictions to get whole life, period. And then even if there are some places that do have a version of a whole life policy, it's not as well calibrated for use in this infinite banking context as the policies in the US and Canada.
Let's say that
So,
it's not as robust.
right. And
Let's
just to
say,
give your listeners an idea what I mean, like in the US, if you were going to take out a policy from scratch for this purpose, there's ways you can, there's certain riders and things you can do with it such that technically, like every month when you make your premium payment, a certain portion is going for like the underlying base policy, but then another portion is buying what's called paid up insurance.
right.
And so it's like one shot, single premium payments that are just augmenting. And so, it's a complicated thing, but the point is that allows your cash value to grow more rapidly for a given flow of, premium payments on your part as the policyholder relative to just a pure plain vanilla whole life policy. So like, again, even if there's other jurisdictions that have whole life in the product mix that the carriers offer, typically outside of the US and Canada, they're not going to be as optimized for this purpose.
And I know there's going to be a lot of listeners here that their eyes are glazing over. They're like, I have no interest in life insurance, and they're getting into all this stuff. But I just want to point out, even if you don't listen to the end of this, you should look into this, because if you look at most of the wealthy families and most of the people that are rich, this is one of their vehicles for preserving their heritage, for preserving wealth and passing it on to the next generation. And it's also a way that they're using to finance different investments. So one of the things, and like I said, I know we're getting to Infineo, but I'm going to go back. One of the great things that people are doing is buying real estate and using the cash flow from the real estate to pay the investment and the premiums on the insurance. So they're funding the insurance through the cash flow from the real estate, and they're borrowing the money to buy the real estate from the insurance. So it's kind of like a circular thing. I've heard people call it the infinite flywheel. It's probably not that, but I mean, you can't beat a better thing than that. And also, I do recommend, if people are looking to get into Bitcoin and stuff like that, and they want a dollar cost average, if you pair that with real estate and dollar cost average into Bitcoin, over time, you're going to get a much smoother ride. But I really like pairing, cash flowing real estate, commercial real estate, with the infinite banking concept. So
Yeah, great points, Michael. Let me just piggyback on some of what you said there. So as far as, like you say, someone thinking like, okay, yeah, this is some esoteric thing for people who are really into the mechanics of life insurance, but I don't care about that. Why should you care? Sharp ratio of 3.0, right? Over the analysis I recently did, at Infineo, in my role as the chief economist, I went through. And so what that's showing, for people, the Sharp ratio is like the risk adjusted return. The idea is, for a given asset, how much does it outperform relative to whatever the benchmark is, the safe asset that you're picking for the analysis. But then also you look at what's the volatility or what's the standard deviation of those returns. So yeah, the stock market typically is going to outperform, T-bills, but also the stock market's pretty volatile, right?
right.
Real estate outperforms T-bills, sure, but it's also could be volatile. So the thing that's really special about properly curated whole life insurance policies, like the ones that we would let into this pool, is it's not just that the rate of return is typically going to be around a corporate AAA corporate bond level returns over time. That's typically how it plays out. But also the volatility is incredibly low. I looked at, I did an analysis looking at real estate, S&P 500, and by real estate I mean the Case-Shiller USA index.
Yeah, that's residential real
Yep.
estate.
AAA corporate bonds, and Bitcoin as well for the shorter time period that it's been around. And the volatility, and even T-bills and 10-year treasury, and the volatility of the annual rates of return, again, meaning how much does the cash value go up if I make the premium payment, and take into account that you had to make the premium payment, that, you have to, that dings it. But looking at those annual rates of return over a 30-year stretch, the volatility of the whole life policies returns was way lower than anything else, even the treasuries. And so that's the sense in which it just popped out of that analysis that the Sharpe ratio was actually a 3.0, which is great for people who don't have that frame of reference. So that's my point. Another way of putting it, or another element of it, is it's got corporate like bond returns with zero interest rate risk. And so what I mean by that is because, again, you've got this cash at any given time, even if we, as the administrators of this sound token, we have this pool at any given time, we can just surrender any one of the policies that's in the pool to the carrier to get the, the cash surrender value. That's what the term means. So even if interest rates rise, our pool doesn't go down in market value because we've got that floor built. Whereas you're sitting on a bunch of treasuries and the interest rates rise, as SBV showed, the market value of your portfolio drops. So again, just trying to show, once you understand how this thing works as an asset class, it's got a lot of interesting properties. And the reason portfolio managers aren't piling into this already is that for all those, logistical reasons I said earlier, it's just kind of hard to get your hands on these things and to deal with them. They're bespoke, it's not like they're homogeneous. But if Infineo is administering it on your behalf and all you're seeing is how much did I pay to get into the sound token, and then how's the NAV march up over time, and you can borrow against it with smart contracts and whatnot, like we're mimicking all the benefits of having these policies while avoiding all the, the roadblocks.
Yeah, and there are funds out there that will do, and I forget what they call it, but invest in, life insurance policies and things like that. I think the key thing with Infineo, which is why I like it, is the flexibility that potentially you're going to have some sort of liquidity. But the other thing that most people don't consider, I'm looking down the road, and if this, gets you talked about net NAV, which is net asset value. If the net asset value is, pretty much stable and stuff, you should be able to actually, if me, the investor, invest in the Infineo token, I should be able to borrow against that and lock it in a DeFi protocol to get some liquidity if I needed some liquidity, which you really can't do if you're in one of the private funds that are administered. The other thing that you brought up is administration. So I assume you're not only underwriting the life insurance contract, but you're also underwriting the actual life insurance carrier. And there's certain carriers that you wouldn't do, and there's other carriers that you look for, correct?
Yes. I mean, is a general rule, right, that we do take into account. We want to make even, making sure that we don't have too much exposure to any given, even if the carrier is good as far as we, just to try to mix things up. So
But you're not
just
putting
minimizing
Mike and Bob's, life insurance company with,
right. Exactly.
State Farm and Mass Mutual and those guys.
Right. So yeah, the upon the initial acquisition, we have various criteria for this is what we want. And then, one of the things we can specify is, from a carrier with, a minimum rating or, whatever list of carriers that these are all past the test, but again, we don't want the portfolio to be too heavily exposed to one particular carrier, that sort of thing.
And don't quote me on this, but I believe the oldest company in the world is a life insurance company, isn't it? Or it might be a bar over in England, but I'm pretty sure one of the older companies in the world is life insurance companies.
I mean, I don't know that independently. That wouldn't shock me because I know that, some of these things go back to like the 1600s or whatnot, depending on how you classify it. And it's, it was the, Minister's Relief for Poor Widows, and that turned into this company, that kind of thing.
Right.
So yeah, that wouldn't surprise me. A lot of this stuff, it was like original, like mutual aid societies where the community just kind of knew we all kick in money every month. And then if somebody's husband dies and she's got a bunch of kids, we kind of help her out for a while, that kind of stuff. And then it just got more formalized with contracts and premium payments.
I'm just trying to like change people's minds because and I was just on a call with a guy today because we've got a residential sale leaseback fund, and we're buying properties at 40 to 60% below market value, and they're residential houses. So I like to say safe as houses, but we're even in lower than what banks are. And we're running into investors like, well, I could get like 14%, on this other deal. I'm like, well, yeah, but is the likelihood of you actually getting the 14% there versus something that's and so I'm trying to steer a lot more people and educate a lot more people. It's like you can get a really good risk adjusted rate of return without having to stick your money in a bank and get zero return, or without having to put your money into a T-bill. But at the same time, get, I think, comparable risks to, those, especially like that's why I'm stressing the fact that like these life insurance companies have been around forever, and you're doing a diversified portfolio with the Infinity Sound token.
Yeah, and the other thing too, like just as far as the safety and whatnot, is that for a lot of these carriers, they like what can happen in the rare event when a particular carrier does get into financial trouble, like they were investing in bonds that didn't turn out well or whatever. Other carriers will typically come in and take over those policies.
Right.
Just because it's in the industry's interest. Like again, people aren't getting into life insurance because of the spectacular returns on the quarterly report to shareholders. That's not why. You want to just know if I die, my widow is getting this money or whatever, it is. And so that's, they want that conservatism. And so it's in the industries. They don't want there to be high profile cases of a carrier going down and those people, oh, they defaulted on their policy. So there's that element. But even beyond that, typically, they're regulated at the state level and there's state guarantee funds where, the carriers all pay into this thing. And then, if a carrier does get into trouble, then, the state can come in and, say, okay, we've got these reserves that we can make whole these particular
And now that you brought
policyholders.
that up, I just remembered as you were bringing that up, we were involved with one where the insurance company did go under, and then the New York State Insurance Fund came in, basically put it into receivership, and then like dismantled it and resolved all the issues. So the life insurance stuff is regulated too. It's
Yeah,
just
and just like, high profile, like people say, didn't AIG get into trouble? And yes, it did, but that was, back during when the financial crisis hit. But that was like the wing of their enterprise that was, issuing credit default swaps and stuff. The underlying assets backing up AIG's life insurance was segregated, by the regulators. And even if they had just let AIG fail, those life policies would have been fine. You know what I mean? Like,
I'm not even going to go down the AIG road, but that was screwed up by Elliot Spitzer and Mo Greenberg. All of his stuff never went under, but Elliot Spitzer basically stole AIG from Mo Greenberg. This is getting too deep in the weeds, but AIG was a government failure. So
I'm sure. Yeah, I probably would agree with you if if I saw exactly what you're talking about. But yes,
yeah,
all I know for sure is on that one, the narrow point I'm making is people associate that. And again, it was,
yeah, Elliot.
My views, Mike. I'm not a big fan of government regulation, but I am just saying when it comes to life insurance that, they have very conservative rules in place for the segregation of assets and
Elliot
such
Spitzer
that,
was the disgraced governor of New York. He was the AG at the time. He went over and like just destroyed a perfectly working company because evidently he had some sort of issue with the Greenbergs. And like I say, Mo Greenberg split, most of the company off into another company. His company never had any problems. The one that Elliot Spitzer, destroyed was the one that went under, and it was a publicly traded company too. It's not a mutual company. So
yeah, and just again for people, so the mutual company, folks, means that the policyholder is like the shareholder in the company, as it were. And so it's just a different philosophy. I mean, it's a different legal structure, but also just in terms of the conservatism that the investment committee that decides, okay, we as the carrier, we have all these premium payments coming, we got to put them to work buying assets. If they don't have an independent, group of shareholders that are just looking at the quarterly reports, they can be more conservative and just do what's in the interest of the long-term survival, likelihood of the carrier as an institution, as opposed to, oh, we got to give a good rate of return to our shareholders when the shareholders are actually just the underlying policy holders.
right. Bob, is there anything, because we're getting close to time to wrap up, is there anything that we missed on Infineo? And I'm going
real quick. So our product, so that this, we've been talking about the sound token, that's not yet available. We hope it will be available possibly as early as, the end of this calendar year, 2024, if not, first quarter 2025. But what is available right now is what's called our policy ledger. And so there, people, they're not transferring legal ownership. You keep your conventional, paper-based life insurance policy, but you can get a digital twin on the blockchain right away. And why would you do that, among other things, besides just preparation for when, our marketplace is up and running and, you can get bids from people around the world and borrow against it and so forth. That's all coming. But what you do right now is, if you so choose, you can give us your contact information and those of your beneficiaries, and then our system periodically checks in with you to make sure you're still with us. And if you're not, then eventually it emails the right information to your beneficiaries so they can very easily say, oh, this is the carrier, the policy number, blah, blah, blah. So when Uncle Jack dies, his next of kin aren't fumbling around looking for the policy. They have that information at their fingertips while they're planning the funeral, just, peace of mind. So again, if you just go to Infineo.ai, you'll see the button for the policy ledger, see an explainer video if you're curious to learn more about that. And as of right now, we got 125 something million already on chain just through that mechanism.
And we're going to add the explainer video to the end of this so that you'll be able to see it. But the other important thing about the policy ledger is there are, hundreds of millions, if not billions of dollars of life insurance that go unclaimed because people don't know that or their beneficiaries don't know that they have it. And it's sometimes not in the interest of the insurance company to do a whole bunch of finding to try and track them down.
Yeah. So the statistic we could dig, that some outside agency did a assessment of it. But yeah, it was something like 7.9 billion. And I think that they call it stranded death benefit. And there, depending on the state, it's not even that the carriers they have to give the money. I think the state takes the money. So the carrier, it's not that they're holding back. It's just that they can't locate the beneficiaries. And so, yes, the policy ledger alleviates that worst case scenario where literally the beneficiaries never get the death benefit payment. But I'm saying even in the more standard case where, the kids eventually find dad's policy number in a drawer or something, or they call 5 different carriers and figure out, where did he have that policy with? Here, it just, gives it to them. But yes, our system solves for that. So, you're going through all the trouble. You're doing the right thing by having this life insurance policy in force for 30 years. You've been funding. You want to make sure when you pass, your beneficiaries get the money. And so that's what one function of the policy ledger is. You program all that contact info in, and then it makes sure that they get notified so they can go make their claim.
Right. Perfect. And it is that what we're going to do is we're going to link to the Infineo.ai website. Bob is also going to give us a link to his white paper. So we're going to have that in the show notes. Is there anything else that you wanted to cover, Bob?
A whole other thing that we're getting into here at Infineo is with artificial intelligence. We have an AI engine called AI Bob that, is programmed with my writings and such. That he's kind of neat. That people go to the Infineo.ai, you can find him. If you go to the policy ledger, you'll see him, the little chat bot. But that it's kind of a neat thing. We're just trying to educate people because we realize part of the hurdle here, besides the tech, is just people don't understand. Even seasoned professionals in the financial sector, they have no idea how permanent life insurance even works. Right. And so if we're trying to bring, open this up as a new asset class, we realize we got to educate people. And so that's one of the things we're focusing on, is developing that interactive thing. So this AI Bob system can speak fluently in 20 some languages. I can only speak in 1.5 languages. So clearly this thing is better than I am, and it doesn't need to sleep.
Nice. Very nice. Well, that's the way of the future. We're involved with a few AI education projects too. So maybe we should reach out to you and, get a special, life insurance course, and also economics, Miesian economics or Austrian economics course from you. So
sounds good, Michael.
with that. Well, thank you very much. As always, this was not financial advice. This was not insurance advice. This was not legal advice. This was not accounting advice. You should talk to a competent professional. We are sponsored by the Blockchain Real Estate Summit, which is coming up. We're doing this on September 10th, and it's coming up relatively fast, September 24th through the 26th. Again, it's 3 days packed with action, packed with real world assets, packed with how blockchain is interacting with not only real estate, but also insurance, oil and gas, mining, all kinds of things, because what I always like to say is blockchain is the rails of the financial system of the future.
Well said.
Thank you, Bob.
Thank you, Michael.
Thank you for listening to the Blockchain Real Estate Podcast, hosted by the Blockchain Real Estate Summit. Don't forget to sign up for the Blockchain Real Estate Summit 2024, happening this September 24th through 26th, online for our worldwide audience. Get your tickets at blockchainrealestatesummit.com/registration. If you enjoyed today's episode, please make sure to follow the Blockchain Real Estate Podcast on your favorite platform and leave us a review. Your feedback really helps increase the visibility of our show, allowing us to reach more listeners like you. If you have someone in mind you would like us to interview, you can go to blockchainrealestatesummit.com and leave a comment.
Adam Carswell, the voice of liberty. This podcast is solely intended for informational and entertainment purposes only and is not intended to provide tax, legal, investment, or accounting advice. You should consult your own tax, legal, accounting, or investment advisors before engaging in any transaction or undertaking. Thank you for listening to the Blockchain Real Estate Podcast, which is a part of the Blockchain Real Estate Summit Network. Go to blockchainrealestatesummit.com for more information, free reports, and giveaways with free stuff. Thank you.